Hello all. Today I am discussing about the topic relationship between the CAPM and the WACC. CAPM refers to a model that describes the relationship between the expected return and the risk of investing in a company. Next one is WACC. WACC means weighted average cost of capital. It refers to measure the company's cost of capital, taking into account the proportionate weights of all the different types of capital it uses, such as debt, equity, and a preferred stock. Next one is a relationship between CAPM and the WACC. First one is purpose. CAPM is primarily used to determine the expected return on an investment based on its risk. It only determines the relationship between the expected return and investment based on its risk. It helps the investors and financial analysts to assess whether the potential return of an investment is worth or not. Next one is WACC. It used to calculate the minimum rate of return that earned in order to satisfy all its stakeholders and shareholders. It reflects the average cost of companies' debt and equity financing. Next one is components. CAPM relies on the risk-free rate and a market risk premium and investment to calculate the expected return. It only depends on the risk-free rates and risk-free premium. Next one is WACC. WACC is only depending on the cost of equity, cost of capital, and the company's capital structure, debt, etc. Next is application of WACC and the CAPM. First one is CAPM. CAPM is used to calculate the individual asset assessment of assets and securities such as stock and bond. Next is WACC. WACC is used to calculate the capital budgeting decisions determining accept or reject a merger or acquisition opportunity. Next is risk in CAPM and WACC. CAPM have systematic risk and WACC have unsystematic risk. CAPM have systematic risk, which is the risk cannot be diversified away. It is in a systematic way. It measures the relationship between the investor's return and the overall market return. WACC is a both systematic and unsystematic risk. Unsystematic risk can be diversified away by holding a diversified portfolio. Next is relationship between problem depending upon the relationship between the WACC and the CAPM. Here, BB Puri is considering several investments. The risk-free rate of return is currently 6.75% and the expected return for the market is 12%. What should be the required rate of return for each investment? In this problem, we use the CAPM model. Here, we give security A, B, C, D, and E. Here, beta coefficient is given. A have 1.20, B have 0.80, C have 1.50, D have 0.60, E have 1.25. Next is equation for calculating the expected return. KE equal to RF plus beta J into E into RM minus RF. RF is risk-free rate of return. RM E into RM is expected rate of return. BJ is beta. KE required rate of return. Here, risk-free rate of return is same in all securities, that is 6.75%, and the expected rate of return E of RM is same in all securities, that is 12%. Beta coefficient is changing according to the securities. Here we apply the equation of KE, that is expected return. We get 14.85 percentage, 10.95 percentage, 16.63 percentage, 6.90 percentage, 12 percentage. Here C have highest required rate of return. C have highest rate of return. That is, in this problem, we identify that CAPM model is high in required rate of return, that is C type of securities. That's all about my topic. Thank you.